The banking world was recently rocked by a major outage at Santander Bank. This disruption affected a staggering 14 million customers. Imagine waking up one morning to discover you couldn't access your money. You couldn't make payments. Checking your balance was impossible. This was the harsh reality for millions of Santander Bank customers. The outage lasted for several hours, causing widespread disruption and frustration. Customers were left in the lurch, unable to carry out even the most basic banking tasks. The incident made headlines, raising concerns about the reliability of digital banking infrastructure. It also sparked a debate about the need for better contingency plans in case of such failures. The Santander outage was a wake-up call for the entire banking industry. It highlighted the critical importance of robust and resilient systems. As we delve deeper into the digital age, such incidents serve as valuable lessons, prompting us to examine the strengths and vulnerabilities of our increasingly interconnected financial world. This incident, while disruptive, provides an opportunity for reflection and improvement. It underscores the need for banks to prioritize system resilience and customer communication. The Santander outage brought to light a fundamental dilemma of the digital age: convenience versus vulnerability. Digital banking has undoubtedly made our lives easier. We can check our balances, transfer money, and pay bills with a few taps on our smartphones. However, this ease comes at a price. Our reliance on digital systems makes us vulnerable to their failures. When these systems work seamlessly, we reap the benefits of speed and efficiency, but when they falter, the consequences can be significant, as the Santander outage demonstrated. This incident served as a reminder that our digital dependence has a flip side. We become tethered to the reliability of these systems, placing immense trust in their ability to function flawlessly. The increasing sophistication of cyber attacks adds another layer of complexity. Banks are constantly targeted by hackers seeking to exploit vulnerabilities in their systems. While banks invest heavily in cybersecurity measures, the threat remains real. As we navigate this digital landscape, it is crucial to find the right balance between convenience and security. In an era where staying informed is paramount, banks are increasingly charging for transaction alerts. These alerts, often delivered via text message or email, notify customers of account activity. While basic alerts, such as low balance warnings, may still be free, many banks are introducing fees for more comprehensive alerts. This trend is concerning for several reasons. Firstly, it creates a two-tiered system where those who can afford to pay are better informed about their finances. This can put low-income individuals at a disadvantage, potentially leading to missed payments or overdraft fees. Secondly, it normalizes the idea of paying for services that were once considered standard. What was once a courtesy extended to customers is now becoming another revenue stream for banks. Several banks have already implemented or are considering tiered alert systems. These systems offer different levels of alerts for different prices. For example, a basic package might include only low balance alerts, while a premium package might provide real-time notifications for all transactions. This pay-to-play approach raises concerns about fairness and accessibility in banking. The move towards paid alerts is part of a broader trend of increasing bank fees. The banking landscape is undergoing a gradual but significant transformation. Services that were once offered for free are now increasingly subject to fees. This erosion of free banking is a worrying trend that places an additional burden on consumers, particularly those already struggling financially. One of the most notable examples is the rise of monthly maintenance fees for checking accounts. These fees, often waived for customers who maintain a minimum balance or meet certain criteria, can eat into the already limited resources of low-income individuals. Additionally, banks are charging for services that were once considered routine, such as paper statements, cashier's checks, and even in-person teller transactions. The justification for these fees often boils down to covering operational costs. Banks argue that maintaining branches, upgrading technology, and complying with regulations require significant financial resources. However, critics argue that these fees are disproportionate to the actual costs incurred by banks, and that they disproportionately impact vulnerable populations. This trend towards fee-based banking raises concerns about financial inclusion and accessibility. Section 5. Across the pond. A glimpse into the future of US banking. The United Kingdom has often been a harbinger of banking trends that eventually make their way to the United States. Observing the UK's banking practices can provide valuable insights into what the future might hold for US consumers. In recent years, the UK has witnessed a surge in paid banking services, with fees becoming increasingly commonplace. One notable difference between the UK and the US is the prevalence of packaged bank accounts. These accounts bundle various services, such as travel insurance and mobile phone insurance, for a monthly fee. While these accounts can offer value to some customers, they also raise concerns about transparency and potential mis-selling. Consumers need to carefully scrutinize the terms and conditions to ensure they fully understand what they are paying for. The UK's experience with paid banking services offers both a cautionary tale and potential lessons for the US. It highlights the importance of consumer awareness and advocacy. Consumers need to be informed about their rights and options and to challenge unfair or deceptive practices. It also underscores the role of regulators in ensuring a fair and competitive banking marketplace. Section 6. Lost in the digital maze. Personal tales of banking frustration. While digital banking offers convenience, it also presents its own set of challenges. From confusing interfaces to unhelpful customer service, navigating the digital banking maze can sometimes feel like an insurmountable task. These personal anecdotes highlight the frustrations many consumers experience when dealing with digital banking platforms. One common complaint is the lack of user-friendliness in some banking apps and websites. Navigating through multiple menus, deciphering complex terminology, and struggling to find basic information can be incredibly frustrating. For older adults or those less comfortable with technology, these hurdles can be particularly daunting. Another source of frustration is the impersonal nature of digital banking. When encountering an issue, customers often find themselves interacting with automated systems or chatbots that are unable to provide personalized support. This lack of human interaction can leave customers feeling unheard and undervalued. Section 7. The human touch. Can technology and personal service coexist? As technology continues to reshape the banking industry, a crucial question arises. Can technology and personal service coexist? One of the key benefits of personal banking is the ability to build relationships with knowledgeable staff who understand individual needs and circumstances. This personal touch can be invaluable for complex financial decisions or when facing unexpected financial challenges. However, as branches close and interactions become increasingly digital, this vital human connection is at risk of being lost. The challenge for banks is to find ways to integrate technology without sacrificing the human touch. This requires investing in training for staff to handle both digital and in-person interactions effectively. Striking the right balance between technology and personal service is essential for the future of banking. Section 8. Finding the balance, striking a fair deal for consumers. The trends shaping the banking industry raise important questions about fairness and consumer value. As banks seek new revenue streams and embrace digital transformation, it is crucial to ensure that consumers are not unfairly burdened by excessive fees or denied access to essential services. Transparency is paramount. Banks should clearly communicate fee structures and any changes to services. They should also provide accessible and understandable information about account options, fees and terms and conditions. This transparency empowers consumers to make informed decisions about their finances. Consumer advocacy plays a crucial role. Organizations that advocate for consumer rights in banking can help hold banks accountable and ensure that their practices are fair and transparent. They can also educate consumers about their rights and provide guidance on navigating the complexities of the banking system. Section 9. The road ahead, navigating the evolving banking landscape. The banking industry is at a crossroads. Technological advancements, evolving customer expectations, and economic pressures are reshaping the financial landscape. As we navigate this evolving terrain, it is essential to consider the implications for both consumers and the industry as a whole. The rise of fintech companies and alternative financial service providers is challenging traditional banking models. These new entrants often offer innovative products and services, putting pressure on banks to adapt and innovate. This competition can be beneficial for consumers, driving innovation and potentially leading to better products and services. However, it is crucial to ensure that innovation does not come at the expense of consumer protection. As new financial products and services emerge, regulators need to adapt quickly to address potential risks and ensure a level playing field. The future of banking will likely involve a hybrid model that combines the convenience of digital banking with the personalized touch of human interaction.